These guys are out of Ottawa, but the beauty of it is that the strategies that they use are Canada-wide. So it doesn't matter where you're from. It's not provincial in this case. In this case, it's Canada-wide. So listen, you guys are known for always sharing. You are known for always being open to help everyone else. And that's, I think, one thing that it's kind of part of real estate groups now, and it's kind of the focus is let's share, let's help, but that wasn't always the way it was. But yet, even when it wasn't, you guys still were. And I think that good humanness has always attracted me to you. And what you guys ended up niching into, so maybe you can tell us a little bit about your story, but you ended up in that RSP realm. But let's start talking about how did you even get there? Start with kind of where you began.
Well, for Stuart and I, when we met, we each had just gone through a divorce. So when we put our lives together, it was like, guess what? Divorce really creates a lot of havoc in your finances. And then we met through government, which is where we were working. And we were one of those, 80-20 rules where we did, we were the 20% that did 80% of the work. So we worked long hours. So it was a question we were always trying to figure out, what are we going to do for retirement? Because we had lost so much financially because of the divorce. We started with zero when we got together. Plus, we had lost so much through our retirement funds because of the dot-com bust, the financial crisis. And it was like, what are we going to do? So we attended sessions like business ideas and nothing was really grasping us. And then one time we saw something about real estate and we thought, okay, let's do that. But it turns out that we just said, when are we going to do this? And it was somebody out of the US at the time. And we thought, you know what? I'm glad they had that cool off period because we didn't go for it. We actually backed out. And fast forward a few years. And then we thought, I guess it's time to get back into it, right?
I mean, Denise fell ill and she was off work for over a year. And the day that she was ready to go back to work, she came home at supper time and said, I don't want to do this anymore. And I said, good, quit. Because one of the things that we had done while she was off sick is we decided to try to live just off Stuart's salary. Mm-hmm. And so we put Denise's salary aside just to prove that we only needed the one salary coming in order to be able to live. So Denise calculated up all of the vacation time she had. And the magic date for her to retire from government was January the
29th, 2010, which is the day we started investing, the next day.
In those days, when you left government, they offered a severance pay. They said to Denise, well, you can either take it in cash or you can take it into your RRSP. Well, we had lost so much money in mutual funds, which is the only way that we knew to invest our RRSPs at the time. We said, no, we don't want it in RRSPs. We'll take it in cash. And they said, okay, so here's how much money income tax you have to pay. We said, oh, hang on, we'll take it in RRSPs.
Now, at the time, we started educating ourselves about real estate because we thought we're not going to jump in. We jumped in stocks at one point, lost everything. We thought, okay, we were not educated. We didn't know what we were doing. So we thought we're going to educate ourselves. So we did that before retirement. So that's why when I said I started investing the day after retirement, because we prepared ourselves. And one of the courses we were at, I heard somebody say something about RSP mortgage. Nobody knew who it was. Nobody saw who it was. And I thought that was enough to pique my interest that I made it my mission to find out about it. So that severance pay that I had gotten, I just went to a group of investors, say I have this many thousands of dollars to invest in a second mortgage, because at the time it wasn't for a first full mortgage. And I said, who wants it? And everybody said, pick me, pick me, pick me. And I go, wow, there is something to this. Found a lawyer. We were her very first client. She had never done an RSP mortgage before. We learned together and the rest is history. And that was the very first real estate transaction we did before even buying our very first property.
So after we started buying properties, we realized, hang on a second, we've been lenders using these RRSP mortgages. Why can't we be borrowers?
And that's been a game changer.
And it made a big difference in our lives.
I remember our first one that we did. Sorry, I have a little sick. He's having a rough day today, so he's in his little pouch with me today. Yeah, I remember our first RSP mortgage. It was like, can this actually be this easy? Can this actually have, it almost felt like someone's going to come and ask for it back because it went so easily and is so powerful. So, and I love too that you guys are, you know, and then Denise, we talked about this by text too. You know, we were 23, 24 when we started. And so we had tons of time and room to make mistakes. You guys were retirement age, and we have so many people that we talk to that say, I wish I had started earlier, which I'm sure you do. But it was not too late. It wasn't too late, and it still isn't too late. So I love that part of your.
One of my favorite lines is that the best time to plant a tree is 20 years ago. The second best time to plant a tree is today.
Like, I envy these young people that start in their 20s and 30s. That's great. We were at retirement age. Like, I'm 67 today, and I still have so much more that we want to accomplish and do. And I just find life is just opening up. So hopefully that gives some hope there for people out there, right?
And I mean, the other reason why we like to use registered funds, and that's whether that's RRSPs or tax-free savings accounts or even RRIFs, registered retirement income funds, is the fact that not only does it give us access to funds that allows us to expand our portfolio, but it lets us help other people who are trying to create a retirement income for themselves and are having really, really crappy returns using mutual funds and some of the things that the banks and other financial institutions want to sell them on. So this is a way that not only can we help ourselves, but we can give back.
Totally. I agree. And I think when you see people, you know, and you talk to them about the RSPs and you hear what they're even overjoyed with, you know, I'm pretty happy with mine, I get 6% or whatever it might be. And you hear that kind of talk, it's like, oh, goodness me, somebody needs to help them. And it is true that for me anyways, RSP funds are among the easiest to get because people are stuck in the plan anyway, and they need a better option within it. And you're able to help them. I mean, what better incentive do we have than helping other people, right? So that's awesome.
I mean, one of the things that we've learned is the importance of educating people about why real estate is a decent investment. There's so much crap in the media these days about the housing bubble that's going to burst and the price of houses are going to go down, that mom and dad tend to get a little bit scared about whether they should invest in real estate. So Denise and I spend a lot of time talking with people and giving them comfort that we know what we're doing, that if they invest with us, their money's going to be safe. And that's what anybody that we have taught how to do the same thing we're doing, we tell them that's one of the important things that they need to do.
Okay, so let's talk about that. Let's say that you do have someone that you've, you know, had in your circle in some way or another. You found out that they have RSPs, would like to use their RSPs. What's the first thing that you say to them so that they kind of understand the process of it in a really simple, high level, uncomplicated way? How do you explain it at the very beginning?
We actually have a document that we share, like a white paper that we drafted, that just explains just what real estate is, some of the really basic stuff about real estate, and how they can play in that realm without, you know, dealing with tenants and toilets, and how, again, the main thing is being able to help them with their retirement income as well. Because that's always what gets them, is the fact that they are getting such crappy returns. And I could give you examples after examples, you know, of people that we've talked to. And like one woman who thought she was getting 5%. I met her in a bathroom. I was washing my hands in a hotel. And she turns around to me, she says, I just got my statement. I think I did 5%. Is that good? Total stranger, right? We're not even there at the same event. And I thought, that's kind of odd. But anyways, I said, listen, if you want, I could answer some more questions, but here's my number. If you want, give me a call tomorrow. And she did. When I asked, she had put $60,000 in an RSP the year before. It's the first time she had put money in mutual funds. And now she had her first year statement without adding any extra money in. And she says, I think I did 5%. And I asked her, do you have a calculator? She says, yes. I said, do 60,000 times 5%. For those of you math whizzes right now, you should have come up with 3,000. So I said, what does your statement say? And she said, 60,200. And then she got very quiet. And then she got mad. So again, if you do the calculation, she did 0.033 on her mutual funds. Now, when people understand what exactly they're getting, do you think it makes them more prone to know that there's a better way that they can do this? Absolutely. So we share that.
That's one of the first things you do is find out from them, like have them get their statement out, take a peek and see what they're actually getting. Yeah, brilliant. So now let's say that they, you know, get to that point. what's your next step? How do you quell their fears? Because there's a lot of fear out there. There's a lot of scams. There's a lot of scammers. How do you quell their fears about, taking that extra risk in there? For most people, it's their nest egg. It's their number one, retirement option, even though it's not great. So what do you do there?
When people are not happy with what's happening, they're open to listening to something alternative. Because if they were not looking for something else, they wouldn't even be listening to you. And that happens, and that's okay. But people who are open will listen, and the majority will continue on.
Let's just break that down right there. There's a tip, there's a point, is don't try to convince people that don't want to hear it. If they're not interested, it is a lot of emotional energy, as I'm sure you guys will agree. It's a lot of emotional energy to try to convince them of something that they don't want. But like Denise, you just said it so nicely. When people are not happy with what they're getting, they're interested and open to other suggestions. So guys, take their advice. They've been through so many no's, so much rejection. They can save you some headache right now. If people aren't interested, let it go, walk away, and find someone who is. Okay, so sorry.
Yeah.
We talk about using a ping pong script.
Okay.
And a ping pong script is where you drop a nugget and wait for them to hit the ball back to you.
Yeah.
Did you see how the stock market did last week?
And if they don't respond or anything, or they turn away, guess what? And the thing
How
is,
about those Blue Jays?
and the thing is, when you drop a hint and they have interest, they'll say something back. But again, at that point, you do not start teaching them about real estate. All you're doing is you're opening up the door that they may be open to listen to something. So if they ask something more pointed, well, I don't know, just an example that if we say, yeah, well, we got ours invested in mortgage, they go, well, how does that work? Don't try to tell them either, right? All you say is, how about if we set up a time and we can discuss a little further? Oh, okay. Because at that point, you're probably going to turn them right off if you start explaining anything. You never in quick conversations like that, try to teach people everything you know about real estate. Doesn't work like that.
And we call that fire hosing. We say, like we call it planting a seed, where you've got this dropped, and some are going to, create roots and become little trees, and some are not. And you can't force the ones that aren't going to. But once you've got your little seeds planted, and once they're starting to grow, do you then fire hose them with a whole bunch of water, or do you sprinkle it in nicely, right?
It's kind of funny because, and I tell people this to show them also that not everybody who tells you they're interested and they want to do it will. And I have my list is probably 10 years old, 11 years old. And I have a list of $2.2 million back then that people said, yeah, I'll move my money over. Yeah, I want to do this. I want to move my money over. And even to this day, not one person off that list has moved their money over. And I keep that as a reminder that not everybody will. Just because they say yes, they won't. And again, it goes back to do not push them. When they are ready, they come back, they start asking questions, and then you start bringing them into your circle. You start educating them a little bit more. And that's 100%. What you need to do. There's nothing like you don't ram information down somebody's throat.
Just before we go too far, Melanie's asking, how exactly did you calculate that return again?
If you remember that this is return on investment, is the easiest way to remember how to do the math. So your return, which in the case of the lady that was talking with Denise was $200 on over the investment. So it's divided by the $60,000. So 200 over 60,000, and then multiply it by 100 so you can express it as a percentage.
When you actually had her take out her statements and you said, okay, you've got 60 grand, so a 5% return would be, and it didn't all add up. That's just a beautiful, easy way of getting people to kind of go, oh, crap, what the heck? Yeah, that's awesome.
Yeah, and that happens all the time. I had somebody else who thought they had done 14%. 14% is what they thought. Guess what? When I looked at their statement, 0.66% on one statement, negative 0.24 on the other statement. And she thought she had done 14. Usually my very first question that I ask people is when they tell me they did a certain percentage with their mutual funds or stocks, whatever they have, right? From their statement, I said, is that the fund or is that you? And they go, what? They don't understand the difference. I said, the fund maybe did 14%, but did you?
Right.
And usually the answer is absolutely not.
Yeah. And do you want to explain the difference between that? Because that's a good point. So the difference between how the fund did versus how you do.
Yes, because when the fund is, because they tell them, it actually is on the statement, hey, 14%. So they think they did 14%. The average person does not know how to look at their statement, how to read it, to know where to look to really figure out, okay, I got this much money. If I do times 14%, is that where I was before? They don't know how to do that. They just look at a number and that statement says 14%, but it just is not there.
Up until 2 years ago, there was no obligation on the financial institutions to report what's called a management expense ratio, an MER. And those are the fees. I mean, if you're going to give your money to somebody and ask them to manage it, they're going to charge you a fee for that. And that's to be expected. Same in real estate.
One of the fees they charge.
I mean, in real estate, depending on the agreement you have, if you're the silent money partner and you just want to give your money to somebody, you can't expect a 50-50 split on the returns coming out of that investment. So the same thing happens in mutual funds. The big thing is that if you've got $100,000 invested in a fund, the management exchange ratio, the management fees are charged on the full $100,000 value of your investment. So even if the fund does a return before the money goes into your account, the management company takes their share out. And I saw a great calculation once of $100,000 invested at 8% over 25 years. And then a side-by-side comparison with $100,000 invested in a mutual fund at a 2.5% management fee over that same 25 years, returning an average of 8%. Basically what happened is with the management fee over the 25 years, it ate up half of the returns.
Yeah. Okay. So the big difference between the fund making money, sure thing, but then how much actually equated to back to your account is minus the fees, minus even some people, all kinds of different fees that can come out of there. So that's the biggest difference. So, and let me ask you guys, of those people that you do this with, let's say that you do 10 of these, let me see I'll help you figure out your RSPs. So again, you're being of service, you're being good humans, you're being helpful. Of those 10 people, let's say, how many people are going to place their RSPs with you? I know it's not 10, but how many would it be?
Oh my goodness. I'd probably say about 80% of them.
Okay. Wow.
Just because we've earned a reputation over the years, and a lot of them sometimes come in referred, or we nurture, like finding a lender is building relationships. So you build those relationships, they eventually come around. So sometimes it's just a question of time. That's all it is. It's just a question of time.
I mean, we talk about this one couple that we knew through our church. They had gotten caught in a bad investment years ago where they had put a lot of their RRSPs into a mortgage on property that turned out to be a bit of a scam. And they lost about $70,000, which was a significant amount. They were not well off. So they knew that we were investing in real estate. We had talked with them about the fact that we could put their RRSPs to work for them, but they were timid. They were shy.
And that's okay.
And frequently when I was at the church volunteering, our friend would ask me about, well, what's happening in your latest investment? What are you doing now in real estate? Over 5 years. It took 5 years for them to reach a comfort level where they decided, okay, we'll try this.
But first they sat down with us and saying, the reason why, first of all, they kept asking us. So I would pull out my phone and I'd show them one of the latest projects show them, we were doing renovations or whatever. And they'd always be interested in finding out a little bit more of what we were doing. So again, move over several years later, they said, okay, we've known you long enough now. We're ready to invest, and not realizing they still had another $70K left in another account, which had been sitting there for those 6 years, actually doing nothing. So finally, now they're on their 5th mortgage with us.
Yeah, that's awesome. And the beauty of it is that you didn't push them into it. You planted those seeds, or did your ping pong conversations, or I love the analogy too. And then you just let them come to you, and in their time they did, and that's why it worked out. But one thing I really love about what you're saying is it's all about relationships. And that is one thing that we see a lot of, is that, sometimes we rush that relationship. And so we go from, meeting to first date to second date to third date all within a week, and we just think like, oh man, like, you know, all of a sudden we're talking about how many kids we're going to have, and you know, how many properties we're buying together, and it's just this massive like commitment and in your face stuff. But what you're saying, and what we've been preaching for years too, is it takes time, and you can't rush these things. And that's also why you have to keep sprinkling those seeds and having those, you know, little drops of, you know, every time, oh, here, this is the little renovation project we're doing. And over time that builds trust. And I know you guys are like that just because you have such a good reputation after all these years. So,
and the other thing I should mention for anyone who thinks that this is a simple strategy, it's simple. It might not be easy. It takes some work, because when you're using the sprinkling, if you only plant one seed and try to sprinkle that, hoping you're going to get a field of corn, it's not going to work.
No.
So you need to talk to a lot of people.
So let's talk. Liz has a question, and I know this is kind of where you guys specialize. So this is really good stuff. So what kind of projects do you use for using other people's money or RRSPs?
Well, this is the fun part, because what we have is we actually have some visuals. So we put together just a quick PowerPoint of just some of the projects that we've used RRSPs on, so that people kind of see what this is. This one here is a rent to own. I noticed your banner could maybe change it, chart, but this was a rent to own. And this is when we've done rent to own, is we've been lucky enough, I guess, if you wanted, but with the program that we used back then, is we had a 10% option payment by the tenant buyer. We closed with our funds on a traditional mortgage, right? So we had 10% from the client, and then we put in a 10% RRSP mortgage after the fact, which meant that the only money that we had in there was our closing costs.
Nice.
So yes, so that is a very fruitful way to be able to do this. Let's go on to the next one. Yeah.
So in this case, this was a property that we bought. It housed 54 cats. The family were hoarders.
Wow.
They were 2 weeks away from going bankrupt. And we swooped in, and because we had lined up RRSP investments, we went in with a no conditions offer that got them out within 2 weeks, saved whatever credit they had left. But this house was in horrible condition. If we'd had it appraised, there is no way a bank would have touched it to give us any sort of funding. So,
And the next picture, actually just behind the tree there was, there was an additional room that was there, like a computer room, but there were cat feces everywhere on there. It was in very bad condition. And if you go to the next picture, you're going to see we did the full outside, we did the full inside, but we took out that badly done room and turned it into a carport, and this big double garage. There's probably room for about 8 cars in that driveway.
So on a fix and flip, we had this for, I think, about 7 months when we sold it.
Nice.
So again,
Okay.
a bank doesn't like to refinance that quickly.
Okay, and so let's talk about that. So now you say, oh, well, because we had RSPs lined up. So tell me, that meant that instead of going to the bank and getting a mortgage, you instead pulled some RSP funds and essentially paid cash, correct?
That's exactly what we do with our properties. Yes.
And to be fair, I don't want to mislead anybody. There is a mortgage. We used lawyers.
Yes. Yeah.
The funds were all in Olympia Trust, and we had to do paperwork in order to satisfy the lenders that this was a good deal. Once the lenders agreed, we came up with a commitment document that they all signed. Our lawyer worked with Olympia Trust to get all the paperwork through, and there is a mortgage registered on title.
So again, being on mortgage is a better protection, because I saw somebody just kind of flash by there with a promissory note. Is promissory note, for a lot of people, that is not worth the paper it's written on. And this is the first thing we tell people also. And basically the biggest problem with promissory notes is there's no security attached to it. Whereas when you're on a mortgage, you are a security. It's registered on title.
Yeah, and that's the beauty too that I've always loved about RSPs, is because it's a protected investment. The government has a vested interest in making sure that those funds stay protected. There are guidelines surrounding what can happen to those, what you guys can do with them, what the trustee can do with them. There are, legislation guidelines. Yeah. So, and that's the beauty of it, is that they're not perfect and they don't always, protect everything fully, but they certainly protect much more than promissory notes or anything else that is not secured. RSPs have to be secured against something. And that's the beauty is the government says that, not us. I don't get to decide that as a lender or as a borrower. The government says that's the way it is. Therefore, there's built-in protection.
Exactly.
Yeah, there's so many rules around using it, and they're set by Canada Revenue Agency, the CRA. And then the trustee that we use too is they must put into place the CRA regulations and the rules that are there. So there's a lot of protection that are built in there, and how to use it and everything else. But CRA says, yes, mortgages on secured or secured on Canadian property is a great way to use those RRSPs.
So one of the things that we've found is when you're doing a buy, renovate, rent, and refinance, a lot of times if you go with a traditional mortgage, the financial institution is reluctant to refinance within a short term. They hate to do finances for less than a year. So in this case, this was a property that we bought, and we bought it with an RRSP mortgage. We did the renovation.
We put in a secondary suite on this one here, and then tenanted it, and then we went for a traditional mortgage and pulled our money out from the renovations because we used our own money for renovations on this. So,
because the one thing to keep in mind, I know that last week you had Sean and Sean on talking about mortgages, and they talked about mortgages using private funds. One of the comments that they made, and I agree with fully, is that an RRSP mortgage is basically a private mortgage, so it is for a short term. It's not something that you're going to be looking to hold this property under an RRSP mortgage for 5, 10, even 15 years. You really want to use this for a short-term strategy because you are paying more than you would through a traditional lender. But the advantage is that this gives you so much more flexibility, especially as you're going through and doing a BRRRR strategy.
I mean, the beauty of it too is that when you have everything all lined up and you have these, funds sitting, waiting to be used, you can walk in, like you said, like you did on your last flip, walk in with an all cash, non-conditional offer, and boom, you're able to close on a property in 2 weeks versus having to wait for lenders that who knows what timeline they're at any given space and time. So somebody just asked,
usually you can wait on the refinance, right? So you've got more leeway, but sometimes if you want to close quickly and you have the money available, then yes, you can close. We saw one other flip that we had done is we saw it really bad condition. It took 10 minutes to go from the house to the realtor's office to sign the paperwork. I did 2 calls on the way and I already had the money by the time we signed the offer. And I think we closed in a week.
Let's not pretend that these people were people you spoke to for the first or second or third even time, right, Denise? These were people that you'd already had them. You had multiple conversations. Lots of time had even passed. And so you had that relationship with them.
And those relationships that we build, once we've used them on a mortgage, it's that much easier because they see that their retirement savings are growing. And the other thing that we do also is that one of the main things we tell them also, because we give you examples how they have all these fees, right? They have to pay, so they're not getting the returns that they thought they were getting. So the idea is we pay all the fees. And it's like, what do you mean you pay all the fees? And I go, we do. So you get a true rate of return. So if I say you're going to get 8% and you've got, let's say, $100,000, at the end of 12 months, you've got 8%. You've got that $8,000. It's not 8,000 minus this fee, minus that fee, minus. It's a true rate of return. And people go, wow, that really hits people.
Yes. So let's be clear again, just for those who aren't familiar with this, it doesn't mean there's no fees associated with it. It just means that Denise and Stuart are going to cover those fees, and the projects that they're doing, they've made sure that the numbers make sense enough that they can pull out and cover not only the interest, but the extra fees and still come out on top in their investment. So they've analyzed these deals very well. And there are fees. It's just, they're going to cover them. So they're not coming out of somebody's RSP money. You can either do this with the slides or, one of your examples in your slides or separately, but is there an example? Let's say, numbers wise that, and I know it's complicated sometimes, but, an example of how you would use other people's RSPs. So a house that's, worth 500,000 and then you renovate it or whatever. How did that all come down?
I'll show you through some of the examples. Oh, I just had a thought that I was going to share just before that, and it just kind of slipped, but that's okay. We'll go here and it'll come out anyways. So this particular one is a semi on the left, obviously. This one here is an equity pullout. So this one here, there was $200,000 pulled out of equity out of this property, and it got put into renovating the 13-plex on the other side. once the renovations were done, the appraisal was so much higher that it was amazing the amount of money that got pulled out and still equity left in there, and they still got a lot of cash, in our pockets. So it's just great the way you're able to do this when, like I said, there's just so many different ways. And so just to show you, like this particular flip, when people talk about flip, they think about a small, bungalow or a single family home. This one here is a 23 unit building.
Wow.
And this was owned by the government, and I guess low cost housing for the tenants. It was $500 is what they were paying for this particular as units, right?
Rent in each unit.
The city wanted to sell this, and they said that within a year they would get rid of the tenants as well. So as soon as tenants were being moved out, because they relocated and that, the units were being renovated. So the rents went from $500 to the very first unit renovated was $1,450. And then,
wow.
Yes, and then they went up after that as more units got renovated. So this particular building was bought for $1.8 million. Let's just say that the appraisal, well, you could probably triple it, right, from the appraisal. And
right.
It's sold. It's actually closing in April.
Amazing. So you pretty much carried out let's say what more people would know as a BRRRR strategy on one of these kind of multi-units, but instead of refinancing and keeping the money and then renting it out, you sold it after you had improved that value.
Exactly.
Yeah. So another one is this particular property, which is kind of interesting. It's a huge property. It's 186 feet by 115 deep. This is the view from the top. Look at the piece of land that's there. Look at those homes in the back, which are two-story homes. So this piece of land is huge, and we bought this. This one here cost us $1.327 million for this property. It has an existing building on it with a secondary dwelling unit. We've already done the severance for the lot that is on the side, because that's the first one that's being built this spring. And then we're continuing with the severance. And the only reason we didn't do the severance right away on the others is because we would have had to knock down the property right away. We didn't want to do that. So the property that's there, they've been asked now to leave by the end of the summer, by the end of July, because the severance should be in by then. And then we can build the other two units. But that kind of gives you the proposed plan of what we're doing on those, what's going to be severed into 3 lots. They're going to be semi-detached with secondary dwelling units on those particular ones.
So 1.3, let's say, was the cost you paid for that with your RSPs, with people's RSPs.
That's correct. Yeah, we did 100% loan to value. The purchase price was done with an RRSP mortgage. And so that's carrying us through all of the development phase. And then as we carve out and sell off or refinance these 3 structures, each of those holds 4 units. It's a semi-detached with secondary suite.
4 big units. So it's going to be 12 in total once we're done. Each building is going to be multi-millions of dollars as it's worth once it's done.
Yeah.
So to pay 1.3 to buy the lot with 1 bungalow on there, and that is, helping to pay the fees and stuff like that. But the one thing I want to make sure that people understand is we talk about using RRSPs for mortgages and stuff like that. However, what you should always look at is you would never buy a property with paying market rates. The idea is when you buy a property, I shouldn't say just buy market rates. You have to buy with some sort of equity, or you have to buy with knowing that you're buying here, but the value is going to be here afterwards. If you cannot prove an increase in value of your property, don't do it, period.
Yeah,
must, because the whole idea is when you refinance, when you sell, whatever it is that you do at the end, pays out all of the fees, the RSPs, it pays out all of the interest, and it pays out all of the fees that are still owing on that. So that is so super important. Must increase the value significantly.
Yeah. So if we look back at the previous slide there, if we look at that one, and your development projects where you bought it for $1.5 million, now you're putting in more RSP funds probably to be building and getting the development. Oh, okay, because you're 100%.
Yeah, we
Okay.
just buy the property. We use our own funds for surveyors and all the soft cost that you need to do before you can actually build. And then we go with the traditional construction financing on
Oh,
this.
okay. Perfect.
And that
Nice.
pays out the mortgage. Yes. So we go to a construction financing when we build.
You look at this and say, you guys are going to be paying what? I don't know, what rate do you guys pay on this? Well, go ahead. What
First
rate do you pay?
mortgage, 8% on a first mortgage.
Perfect. So you think, 8%, man, I can get a first mortgage at, 3, 2, 2.5, even whatever. So, wow, you're paying crazy money to have these mortgages. Why and how does that make sense? But like you just said, Denise, when you are making sure that the ARV that is coming out of it and or the forced depreciation that's coming into it from renovations or additional suites, or like you've done here, additional buildings, then you look at it and go, well, we're paying 8%. And yeah, is that hefty money? Yeah, sure. But it allows us to get this deal done nice, easily, not worrying about it, helping other people build their nest egg. And it all works.
And the other thing to keep in mind, Tiffany, is that we might have been able to get traditional financing at 3 or 4%,
or less, yeah.
But it would have been at a maybe 50% loan to value, at best a 65% loan to value. So we would have had to come up with the other 35 to 40% in cash in order just to acquire the land.
And with a traditional mortgage, you got to pay monthly. And when you're dealing with RSPs, we don't.
There's another beautiful point. So let's talk about RSPs and the different payment options. So we've got balloon payments, we've got, different things. So what are some of those things that you guys do?
Because it's registered funds. And what we've been able to do, and remember, I was a lender before I became a borrower. And I can give you an example, which is why we do this. We invested in high-end flips in Toronto with other people that were doing high-end flips in Toronto. We'd invest there. And I remember the time that I got a call and they said, Denise, we'd like to borrow, this amount of money, because they were buying a property for $765,000 and knocking it down and rebuilding. And they said, we're looking for money for 9 months. And I go, 9 months? I go, no. And I could just see, oh. And I said, I'll do 12. They go, what? I said, has it ever happened that you did not finish a project on time? And they go, well, yeah. And I said, well, then I'll tell you what, at the end of 9 months, if you're not done, let's remove that pressure. We'll do 12 months. We do absolutely no prepayment penalties. If you need more time at 9 months, you're not worrying, oh my gosh, are they going to foreclose for us? Are they going to tell us sell the property? Or like, how are we going to pay this money back? I said, let's remove the stress. We'll give you extra time. And that way, once you're done, then just pay us out. And you know what? They paid us out 1 week short of 10 months. And all they could say was, thank you, thank you, thank you. So I like to borrow the way I lend. And plus I told them, it's RSPs. What am I going to do? If I get a monthly payment, it just sits there in the account. So I said, just keep that cash flow going and put it in the project, which is what you want to do, and just balloon payment at the end, which is what we did. And everybody's happy.
Okay, beautiful. So guys, balloon payment is basically, there is a mandated portion that you will have to pay on a regular basis, just because the government, again, legislates that you will. But the rest of it, and the majority of it, you pay at the end of the term. So you're not paying those monthly payments. And like these guys have just finished saying, the beauty of that is that you don't have that stress of making payments before you're actually creating income off of these properties or this land or whatever it might be. So what loan to value will you go up to? Okay, so that's one question. The other question, what percentage purchase price or loan to value can you put an RSP up to? So let's talk about the legalities of what can we do legally and what do you choose to do?
Well, because we use Olympia Trust as our trustee of choice. So whenever we deal with lenders or whatever, and we help them move their money over to Olympia Trust is probably one of the top trustees out there to deal with RSPs. One of the things we did is we did a lot of research. We contacted several companies, like the top ones being B2B, Canadian Western Trust, Olympia Trust, and at the time there was Community. Community Trust now stopped doing these RSP mortgages last year. So looking at the top three and comparing everything, what it boils down to is that Olympia Trust is probably the easiest, the most service-oriented, and the less red tape out of all top 3 that are out there.
It's so easy to me that it's crazy, yet it seems like it's so complicated, but it is so freaking easy. Once you do it, you're like, what am I missing? I must be missing something because it can't have been done so easily. It's an awesome,
and people just don't know what it is, right? There's a lot of steps involved, but you need to understand what you're doing or you can get into a lot of trouble. But the one thing why we like Olympia Trust too is we used to use TD Waterhouse, but in 2013, they stopped doing RRSP mortgages. So we had to find somebody else. So we had done research then, picked Olympia Trust. And even at that, because of what we do, and again, periodically just checking to see who's doing out there. Now, Olympia Trust, a few years back, we were the very first people to actually do an RRSP mortgage in Quebec because they opened up Quebec. No other trustee will do an RRSP mortgage in Quebec. Olympia Trust will, which makes a big difference. Plus, Olympia Trust allows to do 100% loan to value. B2B does, Canadian Western Trust does not. Olympia Trust will allow first, second, third mortgages. We tend to do first and second. We have done third, but that's what, because there's so much equity and what they're asking for is so little that, you know, most people would say, oh no, it's too risky. Well, it all depends on, you know, how much loan to value that is on that. So usually when we buy our properties, we we give the lender an investor package, because people won't just go to 100% loan to value or even understand. First of all, we tell people you should never invest until you understand what you're investing in. Yeah. So we've perfected our investor package over the years because we've been doing this for 12 years, right? So that when people get it, they just like, we call it like like an investor package to get your lender to say yes, because that's what they do. Like we cover everything in there, even all of the risks that there may be that they have and stuff like that, how we cover those. We talk about the project, what's happening, you know, what they're buying in, what it's going to be, what we're going to pay. All of this stuff is all in there. So when they read that and they go, wow, to the point that they usually don't have any questions for us afterwards, because it answers, you know, what it is that they're looking for. Yeah, so that makes it great for us. And they just say, yes. And then we just deal with all of the paperwork and everything else. So yes, we will buy at 100% loan to value, but we've also proven why we do 100% value, because we're buying here and we're going to end up there. Right. So they feel well protected.
On like just a long-term buy and hold rental kind of thing, in a, you know, fairly normal, let's say not flat, but just a normal market, like let's say a 3% market, which is about normal. That may not be the best place for you to be doing 100% loan to value. But when you're in a market that is going up, when you are forcing appreciation in some way or another, is there a place for 100% loan to value? There certainly can be. And remember, guys, that this is still protected by caveat or, you know, a lien on title. And so that's just that little bit more insurance. So,
and the other thing we do, we offer personal guarantees on all our mortgages also.
You know
the one thing we want to do, we want to protect our lenders. These are people that are working hard. They're putting their money aside for their retirement. We do not ever want to leave them so that their retirement is suffering because of mistakes we made. So we offer personal guarantees.
So how do you do that?
We do it with a lawyer. We basically tell them we guarantee it. And there's a form that it'll actually be right on the mortgage that we are guaranteeing this loan. So, even though we're buying in a corporate name, but we personally guarantee it. The banks would get you to do that anyways. When you go for a mortgage, they're going to want your firstborn too, right? So we do, even in our own private mortgages, that's what we do also.
It's interesting
because we always go in with other exit strategies also. So if something changes, then you've got something else that you can use.
So what minimum value do you guys take? Do you take any amount of value? And for what amount of time also is my question.
It all depends on what the property is, for one thing. Because one of our mission in life is to help people. So right from the get-go, we have helped people using some of their smaller amounts. Let's say if it was a 25K, it's harder to use amounts less than 25K because of the cost involved that as a borrower, we pay for this money. However, like I know people that won't accept less than 100K. I know people that won't accept less than the 300K. I mean, they're all over the place, right? But for us, sometimes it costs us a little bit more, but we've been able to help some of these investors that now when they're like several mortgages, their amounts are just growing and they like that. So we're helping them also. However, what I usually tell people, we will go with the larger amounts first, because the other thing is too, we build our mortgages by using several people on the same mortgage. One mortgage, all on the same terms, but it's one mortgage with several people on it. So what we say is that when we're looking for a particular amount, sometimes you need that top up. And that's when I'll go to some of the smaller amounts. And we tell those investors, you know what? You may have a 25K. It may take us a little while to be able to use it. Yeah. And we just closed on one last Friday that one of the people that I had on there was a 30K investment, and she had been waiting 5 months to get on one of our mortgages.
You made it happen though. So
we made it happen.
You're
and
willing
she was happy to wait.
Yeah, right on.
Yeah.
So Grant and Corene are saying, so for larger acquisitions with these multiple RRSP investors that you have, how do you structure that mortgage financing? So is it 3 different positions? Is it an LP? You touched on it a little bit, but do you have more detail?
So basically what will happen is that there's not general partners or limited partners. These are lenders on a mortgage, all with equal status. So let's say, for example, we're doing a $300,000 mortgage. 2 people have come up with $100,000 each, and 2 people have come up with $50,000 each. Basically what happens is they get a share of the mortgage equivalent to the ratio of the money that they've put in. So the first 2 people would have 1/3 of the mortgage, and the last 2 people would have 1/6 of the mortgage. And they would all get treated the same. When it comes time to pay out the mortgage, the lawyer will do the calculations of 1/3 to person A, 1/3 to person B, 1/6 to person C, 1/6 to person D. And so everyone has to be on the same terms. You can't have one person expecting monthly payments when everyone else is ballooned. All the terms, because it's one mortgage, all the terms are the same. Most people are very comfortable with this.
Love it. Thank you for the detailed answer.
And the other thing you had asked us was length of time. Again, it depends on the project, because there's one that we are purchasing very soon, and that's actually the raw land. And we can show you probably really quick on the raw land. This one here is closing at the end of the month. And this one here is a 100-foot lot wide, 200 feet deep. It's on a cul-de-sac. So when we split this into 3 lots with 3 long semis with a secondary dwelling unit on top, they're actually overlooking a big ravine that looks towards the Gatineau Hills.
So for those of you who are not in Ottawa, a cul-de-sac is basically a dead end street.
Yeah. So this particular one, we are not building this year because we're doing other builds. So even though we're buying it now because of the price we were able to get the lot, we already know, because we're going for a 2-year mortgage on this one, but we know we're going to be building in 2023, but we're willing to pay that and build next year. So when we do the construction financing is when we're going to be paying people out. And as you mentioned or referenced a while ago, if we go past 12 months on a private mortgage that is set up through Olympia Trust, we must make at least 1 interest payment per year. So, and they have the minimum to allow.
Sorry, someone did ask what the minimum of that is. So is that 3% still?
It's 2.45% right now.
Oh, okay, perfect.
So sometimes we'll use 4, depending on the project. Sometimes we've used 4%. Sometimes we've used 3%. Sometimes we've used 2.45. So for instance, the one that's going to have the 12 units on it, that one we did at 2.45 because again, it's a $1.327 million. So if we don't have to pay as much at the 12 months, then yes, then we did it that way on that particular one. But it all depends again on the property. So again, this raw land one is, we're just setting up because we know how beautiful those properties are going to be later.
Right. And you know, because you've done the numbers properly, you know that it's still going to be worth it. Even if you're just sitting there paying this while nothing's happening, you know that the numbers are still working out. So it's not like you're just doing this blindly or irresponsibly. You are doing the numbers first, making sure of that, and therefore it sustains it. So I'll just be really clear on that.
Before we actually close on the land, before we've actually finished the offer, we've done our analysis to figure out what the project is going to be. We have a sense as to what the construction costs are going to be. We have a sense as to what the development costs are going to be. So you're right. We've worked all the numbers.
Yeah. Somebody asked about soft costs there too that I saw kind of flip over. You can probably, that was the last slide on that one. In terms of costs, soft costs, when you're looking at sort of those development charges, like do you have to go for a severance? Do you have to go to site plan? Do you have to go to committee adjustments? Do you get zoning change? Do you, so there's so many things. So you're probably looking at probably $200,000 to $300,000 in terms of soft costs, and you don't even have a shovel in the ground yet. So, I mean, it's not for the faint of heart, right? So what you're seeing is our progression over 12 years. You don't start with building and, getting $1.5 million mortgages right from the get-go, right? So you start with your smaller projects and you learn the process. And then with time, you build that list of investors that are willing to invest with you. And the thing is you don't over leverage. That's the one thing, right? So we'll use that 100% to buy it because we can go up to the purchase price. Period. We can do that up to the purchase price. If you were to have an appraisal that would be higher, you could go up to the appraisal, which you could. But again, we still like to have that buffer. So we go to the maximum purchase price, but then we have a lot of our own money invested in there to be able to move the project forward. So even when we were doing flips in that, is we were using our funds for the renovations and then getting reimbursed with profit also, once we cashed out, either when we refinanced or once we sold. This is an advanced strategy, right? This is not a beginner strategy. And I'll be the first one to say is we've never loaned to a first-time investor.
Oh, interesting.
Because they always tell you, right? If anybody's got any mentors out there, right? And you're a mentor to all these people probably online right now. Your very first property is the one you're going to learn the most. That's where you're going to make some of those mistakes and you're going to learn the most. Well, guess what? I don't want my RRSPs with your mistakes, right? So you need to have some experience and understand what it is that you're buying, know how to do the calculations. What happens if something goes wrong? What do? You have to be able to be a problem solver. And this is something that we also teach and we tell everybody when we talk to them about when you're in a mortgage. And if something does not go right, what do? I said, you tell your investors. And people go, oh, what do you mean? Like, I don't want them to know. No. You want them to know because guess what? You should not be telling them about the problem unless you know how to solve it, first of all. So you tell them what the problem is. You tell them what you're doing to resolve that. It may not be fully resolved and you may have to report a few times. But you tell them what you're doing, and guess what you're doing? You're building confidence, you're building trust as you're sharing this information. I want our lenders to know that not everything goes 100% honky-dory, because it doesn't.
Right, 100%. And full transparency, guys. You guys know you've been around a long time. You see those people that try to hide the bad and only talk about the good, and they're not around anymore, are they? You guys have been around a while now, and they're not. And so, yeah, I love it. We could talk all day for sure, but we are actually out of time. So you guys, our team is going to throw your contact information into the feed here so that everyone can contact you if they'd like to. So it's info@deniseandstuart.ca. So, and the team will throw it in there. Thank you. Thank you for continuing to share. You guys are going to come over and join us for our laser session tonight.
We will. And thank you so much for inviting us.
And you guys are just, natural trainers and teachers. And just awesome. If people want to get a hold of you, they know where to find you.
All right. So much. Thank you so much.
Cheers.